Nice to meet you all. Obviously, Ollie and I have spoken before, I think following an introduction from Caroline at Hey Lunos. I don't know if she's on the call, but yeah, like I said, money makes the world go round, and businesses getting from the point of starting up to be able to be independent, standing on their own 2 feet. There's a lot of challenges. There's a lot of things coming out of left field. And as you rightly said, what they're looking at having is different options. Of course, there is the dilution route to go down. Somebody will take 10% of your business for X amount of money. That might be all well and good. In fact, they might bring something to the party, but if you're looking to avoid that, how do you raise funds in days when, you know, it's hard enough setting up a business bank account, let alone trying to speak to them about something or get them to do something like fund you on an asset purchase or a lease. So basically with Portman, we're growing fast. We've been in business since 2007. In that time, we've funded well over £1 billion for various SMEs who were looking to get funds for a variety of reasons. Could be the purchase of an item, could be a general loan for multiple purposes, could be refinancing kit that they've already got. But the various options that are open to businesses, we can assist with all of those. We're agile and entrepreneurial, unlike banks who are oil tankers by any standards, not very maneuverable, not very good at listening. What I run at Portman is a partnership program. So we have various businesses that we are partnered with, some of whom that provide products like Sega. We fund their arcade machines. We work with scaffolding businesses, lasers for tattoo removal, all sorts of different bits of kit that businesses might want to acquire. It's going to make it easier for those companies to sell if they can divide the lump sum payment with a bit of interest added, of course, by 36, 48, 60 months. There are tax advantages in certain circumstances whereby with an operating lease, for example, you can offset the entire costs of that against corporation tax. So whilst younger businesses might not necessarily be moving into profit just yet, when they do, that can be carried over and it can be a tax efficient way of raising funds. In some circumstances, there can be a net cost that's lower than the capital cost once that offset has occurred, depending on the rate of interest and the time that the money is borrowed for. So what we do with Portman is we run a partnership program whereby clients can refer into us. The second side of that is people that provide a service like firms of accountants, wealth managers, franchise consultants, different businesses that are just engaging with multiple different businesses, marketing agencies, so on and so forth. And yeah, we basically handle those referrals, get the funds that the company needs. With the stand-up to startup scenario, it could be either of those things. It could be that there are businesses that are trying to sell something and spreading the cost might make it easier. It could also be that they just have funding requirements internally. Any questions to this point?
Yeah. Justin, I've got a quick question, and Mike has as well. Give me an example of that first option. How would that work in a sort of hypothetical sense?
The introduction side of things.
No, not the introduction.
So beg your pardon, just a company requiring some funding.
Yeah.
Well, they can just get in touch with Portman. I personally don't handle those individual loan requirements. I run the partnership program, but they would be assigned an account manager who would be their single point of contact right from the beginning to the end of the process. And they will initially do a bit of a fact find, get the last set of accounts, 6 months bank statements if those are available. if the business doesn't have that sort of length of time behind it, obviously we can still assist, but it then looks more at the strength of the individual rather than the business concerns. So a private individual might have a big house and a small mortgage, and not with any sort of encumbrance on the property, not with any ties to it, but they can just sign a personal guarantee to assist the strength of a business that perhaps doesn't have the trading history to attract lenders without that comfort and peace of mind.
So we've got members in our community, even some on this call, who are maybe thinking about doing a funding round or doing a funding round and finding that it's very time consuming and there may be better use of their time.
Yes.
In terms of, let's look at some other options. What would you need to come along? What would you typically look for in a founder?
Well, we're both a broker and a lender ourselves. So we broker for 40 or 50 different companies. We lend ourselves off our own back on our own book when we see fit. Each of those entities will have slightly different requirements, but also be slightly different tools for slightly different jobs. Like Investec, for example, are only going to want to fund low risk, stable businesses, and those businesses, because of the small risk they represent, will attract a low rate of interest. There might be scenarios where a company's got less of an obvious lend, but because we work with, I don't know, Armada, who are what we call a tier 2 lender, tier 3 lender probably, they'll take a bigger risk, but because of that bigger risk, just like with insuring a car, they'll be looking to get a higher rate of interest on return. But if you're looking as an alternative at divesting interest in your business, that interest rate in real terms could actually be horrendous if the business really kicks off and you've given 10% away for what you thought the business was worth when you did it, and 12 months later the landscape's entirely different, and then you're sat there regretting it. Whereas obviously all the terms and conditions of any loan that we arrange, any asset finance that we arrange under FCA rules, it's all kind of laid out there from the beginning, so you know exactly what it's going to cost. There might, as I say, in certain scenarios, be tax efficiencies as well to be gained. And it's just a way of doing business where you can see what the costs are, you can see what the benefits are. Whereas with getting rid of some of the business for some money, you don't know really what that's going to cost you, because you don't know how the business is going to fly, what it's going to become worth.
Thanks, Justin. Mike.
Thanks, Ollie. Hi, Justin.
Morning, Mike.
It's just Ollie knows how much I value this group, because you feel like you're speaking to somebody trusted, and I've gone down various different routes, right? As a founder with limited experience, you're trying to understand the landscape of every opportunity that's going to help drive your business forward. And
yes,
the difficulty that I've found is that we're pre-revenue, and because we're pre-revenue, the kind of loan opportunities that are out there seem a bit sharky, if I'm being honest with you. They're either high interest rates, or they, like you said, they want to secure it against your house or whatever. And it's quite funny, because the ones that I've spoken to, they then try and sell to you and sell to you and sell to you, and they're emailing me and ringing me, and that always rings alarm bells for me.
Yeah.
But I think there might be a solution in there, and then the second part is that you kind of prefer, like, the worry is, okay, look, what if this business doesn't grow? What if it doesn't do what we need it to? How are we going to make sure that we can pay this finance back? And I think that's why a lot of founders will go down the route of selling equity in their company, because it has less risk, or it's not tied to their house and things like that. So those are really the reasons why I haven't progressed with it. But I do have something coming up quite quickly, where we have a convertible loan note against the company for some work that's been done, that actually we have an option to pay 50% of that off. I'd very like to do that. Yeah, I don't know what my options are, and actually getting kind of, you know, clear answers on what those options are is difficult. So yeah, I'd love to kind of chat about that, but I guess it's more of a point than it is a question. But yeah,
No, there's definitely bits in there to pick up on. And firstly, we barely do any secured lending. We barely do it. What we normally do is a PG to strengthen a finance application. And it's not the same thing. A personal guarantee is just you saying you will pay back the money you're borrowing and being personally liable for it. Let's just take an easy example. If you've got a £500,000 house and a £100,000 mortgage and £400,000 worth of equity, that makes the bank quite comfortable to lend you £100,000, which is a relatively small percentage of your net worth, but it is not secured against the house. We can go down that route. We do go down that route, but I'd say it's less than 5% of the time, probably much less. What is also available is PG insurance. So you can sign a personal guarantee to make the loan repayments, but if the business is unable to meet that, then you can have an insurance policy that sits in the background that will pick up the tab. And those are the sort of options that we talk to people about when they say, oh, yeah, I'd rather not do a PG. Well, you can do a PG and you can offset that liability. Obviously, there's a cost to it, but it depends how you feel and what level of peace of mind you're looking to achieve.
That makes a lot of sense, and I think for us there is a period where we are going to be negative. We want to, and part of that is because we're licensing a product and because we need to pay staff and things like that. So this just helps us accelerate by getting some cash in. So yeah, I'm really keen to understand what our options are.
Yeah. Again, because I don't personally handle the individual loan requirements, what we could do easily is just set up a call for you to explore the options that are available to you. The beauty of having so many different lenders is that there's almost a home for everything. Obviously, we can't finance everybody that comes our way because there are sometimes detrimental things on people's credit histories. But there's definitely a lot more bandwidth with 50 lenders than there is by just going to your one bank that will have quite a narrow appetite for risk.
Great, thanks.
Yeah, the convertible loan note side of things, I mean, it's definitely something that could be funded, you know, so that you're paying it off and then paying it back.
Yeah, it's a relatively small amount. It's just the percentage that it goes against is more than I'm happy with at the moment. So I'd rather put a loan against it, buy it back, and then we pay that loan off, you know, and we keep the percentage in the business. So yeah, so I'm keen to explore that option. But yeah, it's hard to know kind of which way to turn sometimes. And a lot of the sites that you go to, I went straight to the British bank and you get declined straight away because you're pre-revenue. You know, the first thing I ask you is what revenue are you bringing into the, well, nothing yet.
Yeah.
The startup. So
yeah, I always use the ridiculous example. Like if Richard Branson came to us and said, I've just set up a new business and I'd like to borrow some money to fund XYZ, he'd get the money. It's pre-revenue, but he's credit worthy himself, or at least I assume he is.
put Necker Island on the line for it, guarantee it against that.
Exactly.
No,
Yeah.
thanks, Justin. It's interesting to understand what the process is and what the options are to us out there. So yeah, thank you. I'd like to have a chat.
Yeah, no problem at all, Mike. I'm just looking at my notes to see if there's anything else that I haven't covered from what I wanted to get across.
Have you got any case, Justin? Have you got any case studies where you've worked with a founding team that have been pre-revenue, gone and looked at the non-dilution option as opposed to doing a funding round, and what happened and the sort of outcome of that? Is there any sort of case studies you've got on anything like that or similar?
I could speak to Saul, our head of marketing, on that. Case studies are definitely something we use. Obviously, that's a question that's very much coming from the stand-up to startup kind of lens view of things. But just in general terms, like, we have businesses all the time that are coming to us with a need. We can cater for it, but then 6 months later, things have moved on and there's another requirement. We see a lot of that. Something that's not so much a startup type scenario, but refinancing of equipment. A company might have, I don't know, 20 trucks on their books. They're all on finance, but they've paid that finance down to the point where they've got equity in the trucks. And we had a scenario where we raised a business £500,000 and lowered their monthly payments because of their equity position in items that they were continuing to pay for, but because they were going to continue to use them, money was raised. But just what's really nice is, whether it's the partnership program that I run and working with businesses as they grow, like, for example, we've got quite a few solar businesses on our books, and that's quite a dynamic environment, and funding commercial solar projects. We did one recently in Wellingborough, which is just down the road from our head office in Northampton, where the gym wanted funding for various items, including 100 grand's worth of solar panels on their roof. So we work with lots of businesses where we're helping them grow as introducers to Portman, but also just as businesses. Oh, I've got this need. Great, you've sorted that. Things have moved on. Right now we need this. And that could be, I don't know, a franchisee getting a second, third, fourth Subway franchise. It could be all sorts of different scenarios.
So what we're going to be campaigning for, this government are constantly talking about growth. And for me, they're looking in or asking the wrong people to deliver that growth, the answers. People like industry regulators and whatever else. The people who are going to deliver UK growth sit in this room, founders, all right? The people who create wealth for others, build businesses, create employment opportunities and everything else, pay tax, and whatever. Now, the government, are you aware of any schemes coming through at the moment where the government will help a pre-revenue startup get going, be it through a loan note, a convertible loan note, acting as a sort of guarantor, anything like that at all?
It's kind of the reverse, if I'm honest, Ollie, because the scheme that was originally CBILS that morphed into RLS and is now GGS, Growth Guarantee Scheme, is a government-backed scheme, but it's like 2 years trading history before you can even get access to it.
Right. So
I think you're right. There is a,
well,
you know,
I can't understand why everyone's remaining quiet on this. You know, your industry needs to lobby government on where to help them deliver growth. We certainly need to get in front of them, which we're doing so at the moment through various means. But you know, it seems to me a connectivity issue where we've got all of these people saying we need this, we need GDP to increase, but no one's talking. And the government are talking to industry regulators, the last people they should be speaking to about delivering UK growth. So how do we get the finance industry to back founders and startups?
Well, I think we do already. Like, there aren't any government schemes that do it, but the answer is always in a calculator, Ollie. If a lender looks at a risk and feels it's appropriate, they'll take it, and that's regardless of the time trading, of revenue, of all sorts of things. You know, if somebody is a brand new startup, but is a homeowner with some equity, they can back themselves, they can get the loan, and the lender will back them. So it does exist in that sense. And it's not
fluid enough, Justin. It's not for me. We need a more of a joined up process here, a little bit like how SEIS works. You know, that works well, could work a lot better. No one seems to know about it. Same with patent box. All of these things are out there, and the government should promote it better.
Yeah.
But how do we get that initial money into businesses? It's got to be greater liquidity open for founders.
Yeah, it's definitely the case that there isn't the stepping stones and the assistance out there that could be, but commercial entities in our field will fund people from the get-go. It's just, you know, it starts to get ever so difficult if somebody says, well, I've got a business that's pre-revenue or startup, or it's only been going for 6 months, there's no accounts filed. And then they say, oh, and I'm a non-homeowner in the UK. And that is a really difficult space to fill.
So what about, I guess as a group, you would love the government to come up with a similar scheme to, say, SEIS, where they sort of get in and help founders with initial seed money or getting finance. That would be good for us. It helps us, it helps you. How do we get that conversation going, Justin, with the finance industry?
Good question. I mean, there are trade organizations that I guess Portman are a member of, because we go along to the awards ceremonies and so on and so forth. I guess that would be a good starting point to lobby them and see what their take on it is, seeing things from lots of different perspectives. Obviously, we're Portman, we're an independent broker, but we're
well, I'd be happy, right? And Justin, if you want that conversation with the relevant trade body, I'd be happy to represent founders in that discussion, where we can go to government with some ideas. They will need ideas, things that they can look into, research and see if it's plausible, whereby we come up with a scheme similar to SEIS that's fit for purpose for founders to use, so they can get access to non-dilution funding, which will be good for you, it'll be good for us, and ultimately it'll be good for the country and the government, who want growth over everything at the moment. Brian.
Yeah, sorry, just I suppose from a kind of finance management, accounting, kind of investment appraisal kind of angle to all this, I wonder whether part of the problem is, I'm sort of getting an insight into this because as I say, I'm starting a bit of lecturing with level 2 degree students in business studies, is this lack of knowledge and understanding of what all this is. You know, what is equity, what is debt, what is the difference? You know, I think for younger, certainly generations, I think that's a really big missing piece. I think, to be honest, they don't really fully understand. They don't fully get it. They don't, you know, and then that also sends them down a rabbit hole. Or then equally, when they're approaching people for funding, they don't know. They're not educated enough, if that makes sense. They're not coming with the right information. They're not, you know, I'd be interested to get your insight just in terms of like investment appraisal. What, you know, I'm looking at the material I've been provided by a lecturer over in Liverpool, John Moore, to provide to my students. And I'm thinking, seriously, are we still talking about, you know, MPV and IIR and stuff? And I feel things have moved on, and yet the education is not probably keeping up with it, if that makes sense. You know, still talking about Modigliani and Miller's theories from the 60s and stuff, all just seems a little bit, you know, out of touch, I think. But anyway,
yeah, and I think if there was a Venn diagram, what makes somebody a good entrepreneur, a good founder, and the education that you're talking about, there probably isn't a massive overlap, is there? Like the entrepreneurs a little bit are the outliers. They're not the people that have kind of stuck at the education process for years and years and figured it all out. They just have you know, a passion for a project or an idea, a light bulb moment that they just act upon. And yeah, that means they come to the point without the skills that they necessarily need. So I guess there's mentoring issues and education issues, yeah, across the piece.
But I mean, just in a broad sense, I don't mean as in specifically how to calculate. Like, as I turned around and said to them, you know, the chance of you being asked to work out weighted average cost of capital and an IRR and NPV is pretty remote. But to understand what even just them terms, or have some insight as to what, you know, what debt is, what equity is, you know, and the difference, the relationships, and one pays dividends, one pays, you know, even just high level. I think you don't need to be in the weeds of it, but you need to kind of, you know, so that when you are the person pitching and you get thrown back with a question, Dragon Den's a classic example. You know, entrepreneurs go in there and they get thrown a few finance questions and they're completely at a loss because, you know,
Yeah.
just don't even understand company valuation simply. You know what I mean? I mean, it's
Yeah.
about really deep in there, but I'm just interested to know from you, from a finance industry perspective, so I can show my students, and hopefully, what are the things you are you looking just for the three-way forecast? Are you looking for sensitivity analysis? Are you looking for IRR, NPVs, paybacks? What sort of things are you kind of expecting a young business to kind of come to you with, or understanding of?
Yeah, I suppose the business plan is kind of just made up, isn't it? Like there is projections, but
that's what I've told them. Yeah, it's all forecast.
Finger in the air.
It is a bit,
So,
yeah. But there's finger in the air and there's finger in the air, isn't there? You know, like there's realistic, and then there's like, seriously, you know, so.
Yeah.
I think what you're both getting to here is that we don't necessarily know what our strategy is a lot of the time.
Well,
but also that's live scenario, isn't it? The strategy changes, lessons are learned, and you pivot, and that's part of being an entrepreneur is.
We don't necessarily know what's the route that we should go. Should we dilute? Should we don't know. All these are terms that I've learned in the last 6 months, and I'm 46 years old, you know. So you know, I've been employed most of my career. I'm learning on the fly here, whilst also trying to build a business, trying to build a product, trying to build a team, trying to, you know, go out there and understand what's going on in the world and bring clients on board. So yeah, I think your point was right, Graham. You know, it's like actually what's the right route for me and for my company, and how do I make sure that we stick to that and exhaust those routes before we move into other areas and look for other ways to finance it.
But it's not like there's even a single path. There's different avenues that you can go down that will have implications, but there isn't even necessarily right and wrong. There's just options.
But it feels like most founders, and whenever you get onto a program or you join one of these, etc., everything's about getting funding, right? Everything's about getting investment into the company. And you automatically think of that investment as bringing investors, right? How do I get an investor on board? And then you focus on your pitch deck and you focus on it. And actually, it can draw you away from something that you could have quite easily gone and got some money into the company quite early on and got yourself, I don't know, 50, 60 grand and just started moving, you know? And then once you're moving, it's a lot easier to get that investment in. So, but everything seems to push you towards getting investors to start off. So,
yeah. Series A, Series B, it's all about equity, it's all about dilution. Yeah, whereas
pre-seed, SEIS, seed funding, you know, all of that kind of stuff.
And at the end, bits are essential, but yeah.
And at the end of all of that, the founder who takes the initial risk, does all of the hard, heavy lifting, lands up with 50% of nothing. Yeah. We're seeing a lot of term sheets coming through at the moment, which are very, very predatory, harsh. And, you know, my message to founders, and I speak to lots and lots of founders every month, is always look at your options. I would love to say that this is a good option, non-dilution, finance route, but even this isn't where it needs to be. And that's an industry problem and a government problem. The government should be doing everything they can at the moment to try and give us the tools we need to go to work, and they're not. We're miles away from that.
No, but
I totally agree with Ollie. If I can just come in, my name is Lawal. I run a venture studio in the UK, based in London, and I do speak to a lot of startups as well, and a lot of founders. And we're also trying to fundraise into the startups, but traditional finances is something that's way off. We don't even look at it at all. And the reason for that is because, you know, just to Mike's point earlier, you know, a lot of them are pre-revenue. They're not going to want to tie any assets to any loan facility of any sort. And you know, I know Graham mentioned that some of the founders don't understand the finance options. Well, it's quite limited. And as such, they tend to go for the angels and the VCs. The VCs are set up to understand what startups are and take their bets on startups. And they are happy to invest in early stage startups, pre-revenue, pre-GTM, you know, just come with your idea, with your product. And if it's good enough, they're able to take the risk. However, traditional finance does not take such a risk. And I think that when it comes to structuring something or carving out something for startups in particular, I think it has to be a separate product, because the understanding has to be both ways. And when I talk, well, a separate product from what is what we know as traditionally as kind of offerings that a finance institution will provide to a startup, also to anything like asset finance, for example. And that is also from a regulatory standpoint. You know, you're heavily regulated. There's certain things you just can't do. You can't give out a bad loan, for example, to somebody who has bad credit. You just can't do it. And I think, you know, founders come in all forms. You know, personally, it's not possible to be doing everything Mike said, building your team, taking the risk on your startup, building your product, as well as putting your house on the line. I think that's like way too much. You know, it's like, you know, there's always a risk. I was talking to a VC from the States the other day, and they were telling me of the numerous opportunities that's kind of open from a finance perspective to founders. And I think that even in the UK, if we're going to lobby, you know, we can always take lessons from elsewhere, just to understand how it kind of works, right? You know, and if it's something that we can replicate in the UK, that'll be fantastic. You know, I think there's a huge opportunity here that the government might be missing, from the perspective of, you know, these entrepreneurs that could really shape the landscape, that could really drive the economy. And we're not really tapping into that opportunity from an industry perspective. So there are definitely conversations to be had. I would definitely like to see more finance options open to startups, you know, and pre-revenue startups especially, because you're not going to get anything out of driving innovation if you don't offer finance into that sector.
Oh, you make some brilliant points. I couldn't agree with you enough. Let's book a call, you and I, because I'd like to find out a little bit more about what you do, and how you benefit the founders ecosystem. That'd be awesome. I'll find you on LinkedIn. Brian.
Sorry, yeah, just to jump back in about government and its role and how I think also intergenerational wealth's a massive issue. The inheritance tax changes, whether the government could look at that in terms of like older generations investing in startup, younger generations, that's somehow sheltered from the 7-year inheritance tax, or that there's some sort of tax benefit there that, you know, it would, you know, to try and unlock that capital. And a lot of it tends to be in property, maybe large houses that people can secure monies against, and that money's then in turn is seen differently in terms of, you know, I know SEIS and capital gains stuff, but, you know, can that translate into inheritance tax? And, you know, I think there's a big area there that could be looked at from government perspective as well.
Also on company and pension schemes. We look at the last, you know, you look at subprime, and at the time the government were in a state of flux because they had liquidity problems, and then they were looking over at the private sector, who were sitting on billions and billions and billions of cash reserves, and it's like, oh, give us a, you know, hand here, but they need to come up with schemes that are attractive for the savers, at the same time help liquidity in people like us, because we are the wealth generators. We are the people who create the opportunities, the growth. And when you consider that UK, 61% of the UK, those employed are employed by SMEs. So that's a big part of any group to ignore. You know, we can't be ignored on this. And if it, you know, I know there's been talk about making pension schemes look at startup fundraising and various other things, but at the moment it seems very hypothetical and all about talk. Government got to come up with different ways that they can attract money, lots of money, into this area.
And also, I just wanted to add to that. I think that there's a clear distinction between an SME and a startup.
Yeah.
If you look at models around, well, let's take Rocket Internet and all the startups they created, for example, and let's take some of the big tech firms that we consume without even thinking about it. Amazon, Google, you know, the whole of them, Facebook. There is a period in a startup's journey where they're not going to make money. They're not going to make any revenue. Now, that's a risk for traditional finance. It's like, you know, you can't, you know, you're bound by FCA regulation. And I talked to my friend who owns a bridge finance company, and he can't do that. Lenders can't provide loans currently to this asset class, right? It's just almost impossible. They can look at various options to make it like asset backed, but or collateralize it or whatever the case may be. But you know, I'm not a finance expert, by the way, so pardon me about terms. But you know, it's more like,
yeah. If we consider that every big company out there, you know, the likes of Amazon, the likes of Facebook, Coca-Cola, you name it, they all started as a startup. They all started one day as a startup business, and you know, for every one of those, there's going to be tens, a multiple of 10, 20, whatever it is that have failed. But the wise money's got to be with founders who can build a unicorn and build something that's going to be a wealth generator for generations to come. And with government assistance, there could be a way to de-risk, mitigate risk for a lot of these big finance companies to get involved with more earlier stage businesses. I think there's a blockage there at the moment. I don't think it would need too much to solve, but it's just getting the right people in the room. Because every time I hear the government shouting about we need growth, it's like bashing your head against the wall. Growth is going to come. The growth's going to come from people in this room, people who run SME businesses.
I would want to perhaps look at startups as a subset of SME.
Yeah.
And I think they're characterized differently from a finance perspective. SMEs would be expected to generate revenue maybe in the first 3 months or something. If I give you a loan, you sell X amount of stuff, you know, or you provide X amount of services, you'll be revenue generating. I think the one of the key differences that we've identified, you know, with startups is that it's all about the valuation, right? If you generate some level of traction, and traction does not necessarily equate revenue. It could be number of users on a freemium package, yeah, that could show your potential, and you know, over the course of increased month-on-month traction, you know, there would be the potential of increased valuation, and then I can place a valuation on you for £2 million today, but by the time you have 100,000 users, you know, you're £5 million valuation, and I think, and all that without even generating a single penny in revenue, right? That is a different math, you know, and it's something that when you're talking to VCs, they get that because they kind of tailored, the whole setup is kind of tailored to that. But traditional finance coming into this space will kind of need to understand that there's a way of assessing a startup from a financing standpoint that we need to be quite innovative around, so that we can actually place a certain level of finance to a startup just by the factor of, or just by the fact of the measures that typical startups would be characterized by. It's different, basically.
None of that gets taken into account, though. I took a business in 2023, or 2022, 23. It was a French company. They were doing a little bit of revenue in the UK, doing 400K in the UK. I joined. By the time I left 2 years later, they were doing 4.8 million. None of that's taken into account when I'm trying to raise. It's kind of, that surely what I've been able to achieve in the past should affect whether I'm, a good bet or not.
Yeah, well, I think even venture capital won't take that into account. They'll see it replicated. They want to see you do it again with a new startup. But they definitely take into account that you have achieved that in the past. But if you're creating something new, they want to see that you achieve that level of growth. So growth potential is definitely a metric that might have to be considered. I don't know how, because it's not traditionally the way to go, but
You say a number of users, but there's also, I always think and say to founders, get sales under your belt. There's nothing better than revenue that you can go along to anyone, an investor, a lender, whatever, and say, look, not only is this happening, it's reoccurring income, it's B2B, there's there's value in the type of clients who are buying this. It's value driven, and it's on an upward trend. What I find sometimes is founders get so focused on a fundraise, they forget altogether or don't focus on selling. And many investors want to see that. They want to see that now. They want to see that not only is there a propensity and a desire to be able to sell. I see a brilliant post the other day on LinkedIn, huge VC, and they said one of the biggest things is the founders team and how good at that them founders selling, because it's not only selling the product or the service, it's selling to future investors, it's selling the business and the vision of the business to future employees, and it goes on and it goes on. Sales is such a crucial area, and one of those areas that needs to be mastered by a founder who stands a chance of making it. And I think that whole thing around user and getting validity around that is important, but move that on to sales, fee paying customers. That's gonna have a lot more traction in this market than maybe stuff which is more hypothetical. But I thank everyone for today. Have we got any final questions for Justin? Well, Justin's with us this morning.
No, other than just say thank you.
Oh, sorry, beg your pardon.
So in typical founder fashion, Justin, what I'm going to ask you is by lunchtime today, if we could please get a meeting booked with the head of the Finance Association, so we can put our case to you. We can merge with the finance industry, with lenders, and go and have a proper grown-up conversation with the government about all of this. That's what I want by 2 p.m. today. Not much.
No problem at all, Ollie. But don't underestimate what's there already. Honestly, like we do deals all the time with businesses that are getting off the ground. We can fund things. And like, for example, with the government, they've been saying for 30 years that we don't have enough housing stock. whilst at the same time there are hundreds of thousands of properties empty. Now, like, government just aren't the people to join the dots. The people to join the dots are business people, are entrepreneurs, are founders, are, you know, finance companies like ours, where we just focused on getting stuff done. And like, don't underestimate what's there already. You have to, you know, have a go at raising funds, you know, through entities like Portman, and see what traction you get. That would be my advice, because we've definitely got, you know, people have kind of almost like come to us, oh, I don't think you can help, and then we do.
Ollie, Justin, can I volunteer myself if you have any extra hands to talk to government? I started that conversation myself with the Entrepreneurial Network last year. You know, we were at the House of Lords, and we're trying to have the conversation. So I'm happy to volunteer myself if you ever need extra pair of hands.
Well, I'd love the intro. I will speak to anyone, because this is such an important, it means so much to me that people in the risk takers, the wealth creators, get a fair crack at the whip. And for that to happen, let's have the conversations. Let's all get together and support them, because they need it.
100%.
Well, Justin, you're going to get a lot of love, big ups and respect on LinkedIn and various other social networking places today. It's been a brilliant talk, but
no,
maybe we can have that. Maybe we can have that discussion about trade associations and looking at ways we can help you, help us, help government. It's a win-win-win as far as I can see.
Yeah, it definitely is.
Need some ideas around it.
Brilliant. Thank you, everyone. Appreciate your time.